As Stu mentioned, what I'm going to be doing today is talking about stress testing agricultural returns in Corn Belt agriculture. And this is going to be a forward-looking view. So we're going to be looking at 2013. Excuse me. So what we're trying to do is gauge right now what 2013 returns will look like at this point in time. To do that, I am going to do, oops, now I went too fast. I'm going to do three things. First off, we're going to go over 2013 budgets, and I'm going to have 2013 budgets, 2012 budgets, and a history of budgets from 2009 to the present. This will give us a feel for what we're looking at in both returns or revenues, as well as cost and our cost projections for the 2013 year. Based on that, we're then going to look at 2012 and 2013 income projections. I'm going to start with 2012 income projections just to give us a feel for where we ended at in 2012 and some of the variability that we're seeing on farms as far as 2012 incomes. From there, we're going to go and look at 2013 incomes. And finally, we're going to look at what will cause 2013 incomes to be low. So, and there's a number of things that obviously can cause 2013 incomes to be low. From a gross revenue standpoint, it's primarily going to be a low price alternative that takes us down to our low revenues, or perhaps our low revenues in 2013. Not to get ahead of ourselves there. So those are my topics. I also point out that these slides are in your handout, so if you want to follow along with me, you can do so. So turning here first to the budgets for 2012, and I'm going to show here, this is a corn scenario. This is for central Illinois, so this is also high productivity land. We at the University of Illinois keep 4 of these sets of budgets each year. Northern Illinois, Central Illinois, and Central Illinois is divided into high and low productivity, and then Southern Illinois as well. This happens to be Central Illinois high productivity farmland, and that would be this area. That almost is the definition of this area. To give you a feel for what high productivity farmland looks like, we would expect that on average to have 195 bushel yield. If we could repeat a year 10, 15 times, we would expect that yield on that farm to equal 195 bushels. So if you're looking at these budgets here, the 2013 column, the preliminary column, has yields at 195 bushels. Our Central Illinois low productivity budget would have lower corn yields and soybean yields for that matter. And just to give you a feel, they'd be at 183 bushels per acre. Central Illinois high productivity farmland, and again, the first 3 years here, 2009, 10, and 11, are actual results. So those are from farms enrolled in Illinois Farm Business Farm Management. So those are actual returns here. 2012 and 2013 still are projections. We won't officially know 2012 returns until fall of, or not fall, but winter of 2013 as the farm records are being summarized. To give you a feel here, 2009, 2010, and 2011, we had yields of 192 bushels per acre, 168, 174. Then in 2012, we're coming in with a yield of 121 bushels. Where we come up with that 121 bushel per acre yield is based on what USDA has reported as yields for Central Illinois area. We took the change from 2011 to 2012, applied that to our data, and it came up to 121 bushels per acre. That's how you feel about that yield will depend a lot on what area you're in. There's been a considerable variability in yields. We've heard of yields in this area in the highs of farm averages in the 150, 160s, and obviously much lower than that 121 bushel yield. I don't, for the 2012 projections, I don't get too excited about where that number is, because on most farms, if we're lowering that yield, we're increasing those crop insurance proceeds. As Stu mentioned, there is a variety of crop insurance purchases in the state, but just to give you a feel, overall in this state, about 60% of the policies or 60% of the acres are insured with something that I would call a high-level insurance, revenue protection at 75% or higher, or GRIP policy. Those 60% of the acres, the crop insurance policies are going to offset yield declines. There's 20% of the acres in this state with no insurance, and we attribute a lot of that 20% to share rent landlords. And many times share rent landlords don't take advantage of the crop insurance program. It's available to them, but share rent landlords often don't take advantage of the crop insurance program. And there's 20% of the acres with something else. It's 20% they have insurance, but it's at more modest levels than that 60% at the high level. We're coming again with a 121 bushel yield for 2012. 2013, we're coming in with a projection of 195, and that's a straight line projection. What we do is take the yields from the past 20 years, draw a straight line through them, and it comes out to 195. If you're looking at that and you're saying, well, 2009, 2010, 2011 are all below that 195. Yeah, they are. The 3 years before that, 2004, 2005, we had near 200 bushel yields in this state. So actually the central Illinois area has had lower yields for the last 4 years. Much lower yields this year, and overall, corn yields have been lower than expected for the last 2 years, with this year being much lower than we anticipated, obviously because of the drought. If you're looking at the drought had a much larger impact the further south you went in this state. The epicenter of the drought was in southern Illinois, Missouri, and eastern Kansas. They had the worst corn yields of anybody. Sort of got a little better as you went north from there. We're coming in here with a price of $740 for 2012, and I'm going to tell you right now, farms are going to vary a lot around that $740. I know of a lot of farms, or a lot maybe, I know of farms that hedged a considerable amount of their production in the spring of this year. At that point in time, we were hedging production at 540. And if you hedged production, 50% of your production at 5 to 540 and got lower yields, that 50% of production could now be 75 or 100% of production. So having said that, I wouldn't really fault anybody for making a sale of 5 to 540 at the spring, because we were coming into May. It looked like we were setting up for a pretty good production year. We're coming in with a projection of 580 for 2013. 580 currently is based on what harvest time futures contracts are trading at, minus roughly a 30-cent basis, with maybe even a little bit more conservative than that. We put a basis in this year for 2013. A usual basis, we're not seeing much of a basis in 2012, or the cash price is about the same as the futures price. Currently, we've downed that a little bit. In any case, as you come, as you come down here, we're coming up with $1,099 of gross revenue in 2012. And again, that's at levels of 2011, roughly the same as 2011, and a bit higher than 2009 and 2010. On average, a lot of what we're going to see is gross revenue in 2012 at pretty high levels, near record levels, but you're going to see a drought impacts farms very differently. I mean, and if you're looking at 121 bushel average yield, you know, there's 50 bushels below that and 50 bushels above that. Take away crop insurance and do a little bit of hedging beforehand without crop insurance, and you're looking at a financial stress situation. One other item noting on this gross revenue, we're projecting 1131 for 2013. Again, a pretty good year right now, sitting here with 195 bushel corn, 580. That 580 is higher than where we were at last year this time. We don't have any other government payments in here. That's direct payments. We don't have a farm bill yet. If we get a farm bill, none of the current House or Senate bills have direct payments in there, which is what that $24 is, so we don't have that in there. Here, then we list cost, and our total non-land cost were $514 in 2012, and we're coming in with a projection of $510 for 2013. Essentially flat line cost between 2012 and 2013. And that's non-land costs. That's everything but what paying for the rent. 510, 514 last year, 510 this year. And you'll see some variations in what is composed of non-land cost. Seed is going up roughly 5%, but fertilizer costs are stable to maybe declining a little bit. We have these budgets for 2013 are based on an 850 anhydrous ammonia price, and I don't know what's going to happen in the spring. My best guess is it's 850 right now, and it could be higher or lower than that depending on what happens this winter and other factors. But overall, non-land cost not going up in 2013, and roughly $500 per acre. Quick math here, $500 an acre, $300 cash rent, $800 of total cost, 200 bushels of yield, you got a $4 break-even price. And that's where we're at. We're at break-even prices on corn of $4 and higher. Put a $400 cash rent in there and you're at a $450 break-even price. So our break-even prices are much higher than they were in the 2000 to 2005 period. The final line here gives operator and farmland return. You can see here we're in the $500 for the last 2 years, and we're coming in at $600 for the next year. So sitting here today using trendline yields and prices where futures markets are saying we're looking at a high income year for 2013. Overall, on average, if anything, what the drought did was, in my opinion, when we were sitting here last year, we would say if we have a normal year, we would expect prices to decline. We didn't have a normal year. We had a short crop year, so this drought has delayed the decline in prices. $600 for next year. This is corn. You see similar sorts of projections here for soybeans. Coming down here, we're using 1280 soybeans, $422 operator and farmland return. That operator and farmland return is what's left to split between the farmer and the landlord. If we have a $300 cash rent, $422 operator and farmland return, we have $122 to the farmer. So, again, our projections would be higher operator and farmland returns 2013 right now. We're going to use these incomes or these prices in income projections that I'm going to show you in a minute here. One other note about this, you'll note here that we're coming in with soybeans at $422 Corn at 621. It'll be interesting to see planting decisions this year. The markets are saying plant more corn. The experiences for the last several years are saying don't plant more corn. Corn yields have taken a hard hit, 40, 50 bushels per acre. But the market right now favors corn, and we'll see what producers do. Over time, we come up with a 2/3, 1/3, or 50-50 rotation as sort of being in the range of the optimal over time. So, but we'll see what farmers do this year. So those are the budgets. And again, 2012, we have lower yields, higher prices, and higher crop insurance proceeds. Farms without crop insurance and who did some marketing pre-harvest are going to have worse outcomes this year than other farmers. And I'm going to show you an example of how bad that situation could have been in 2012. One other comment, though, we're going to now begin forecasting prices or forecasting 2013 incomes using 580 corn. I and others, Darrell Good, Scott Irwin, believe we've reached a new plateau since 2006. It's probably closer to $4.50 than $7. So Darrell Good and Scott Irwin, and here this graph just shows monthly prices on corn in Illinois. You can see prior to 2006, we had a plateau right at 244, 243. We had periods when prices were above it. We've had periods when prices were below it. But from 1975 through 2006, it didn't go up or down. Since 2006, we've had higher prices. Since 2006, we've averaged 433, 434. And we've had periods above it, and we've had periods below it. Just to give you a feel, 2009, our average price in Illinois was $3.53. So it may seem like a long time ago now, but or maybe not so long, but we can get low prices, $3.53. We believe that we're above that 454 plateau or 450 plateau right now because of supply disruptions around the world. We're having low corn yields and lower soybean yields across the United States this year, causing shortages, and will cause stocks to be lowered. That was a continuation of last year when corn was not at trendline yields. So we had a bump up in prices last year as well. South America did not have a good crop last year. And the former Soviet Union 2 or 3 years ago had a very poor wheat crop. All of those things have caused the global stocks of feed and food grains to be at low levels. If we ever have quote unquote normal yields again, those stocks will build, and we believe prices will decline. Having said that, I said that last year and it didn't happen, but we still don't believe the fundamentals situation has changed. We're at higher prices because we had shortages or yield shortfalls this year. I'm now going to give you some farm income projections, and I'm going to do this for a very specific farm. It's going to be first off, I'm going to give farm income projections for 2012 just to serve as a baseline for 2013. We're going to do this using 2012 cost, those costs that are listed in the previous slide. So those corn and soybean costs that you saw for 2012, those are the costs that we're going to use for our income projections. We're going to look at a 1,200 acre farm. They're going to grow their expected yield is 187 bushel corn, 54 bushel soybeans. So this is a farm very good farmland, but not the top farmland either. Much of Macon County you would expect better than that in a typical year. This farm's going to be 120 acres owned, 360 acres share rented, and 720 acres cash rent. That's roughly equal to the percentages that exist out there. So farms will vary a lot, obviously, in their tenure structure, and I'm picking a small commercial farm here, 1,200 acres, and giving it a typical rental arrangement. We're going to start out with 300 acres, $300 an acre cash rent, which is about where the average is. If we look at NAS data, we're gonna see that those are in the $300 to $315 an acre range. We're going to start there at 300. I'm going to put that up to 400 just to show what happens there. $480,000 of debt, and this farm took insurance RP, revenue protection, at the 80% coverage level. So and again, so it's in that 60% that took a high coverage level, and it's going to get payments, and you can see their trend-adjusted yields there. Here is what those income projections would look like. First off, I'm going to start here with this. We made these projections of this farm last year in the winter. 187 bushel yield, 54 bushel corn, $5 corn price, $12.50 soybean price, coming out with an income of $191,000. That $191,000 would be more or less in line what it was for the last two or 3 years for this type of farm, but significantly above what it was prior to 2006. So we were saying normal crop, declining prices at that point in time to come up with $191,000 of income. Here's what it looks like when we get closer to what actually happened. $7 corn price, $15.20 soybean price, 100 bushel corn yield, and I don't really care where you put that yield at. If I go lower, I'm just substituting crop insurance payments for crop revenue payments at an 80% coverage level. 42 bushel soybeans, and actually we come up with a little bit higher net income for this farm in 2012 when it's closer to actual, given that it had crop insurance and didn't do any pre-harvest marketing. So drought lowered yields. We increased prices from $5.80 to $7, and crop insurance payments made up the difference. If we take that closer to average scenario and then put no crop insurance, so we take crop insurance out of there, that $228,000 goes down to $19,000. So on this farm, roughly $200,000, that $228,000 of income, $200,000 of it is crop insurance payments. One of the things that are causing large payments this year is the policies that most people took were revenue protection policies, which had the guarantee increase in it. It operated exactly like it should. Guarantee went up when the price went up. That is going to cause some bad publicity, but it worked exactly like it should. No insurance plus hedged 50,000 bushels at $5.20. That $19,000 goes to minus 71. So if you had the combination of no insurance and you hedged at $5.20, you'd come up with a minus $71,000 worth of income. You're looking here, there's that hedging decision cost $90,000. So if you want to go back up here to this 228 and say they hedged 50,000 bushels at $5.20, take off 90,000 from that 228,000. So that would put them down considerably in the $130,000, $140,000 range. You'd feel real bad about the decision, but yeah, that's farming. So just to give you a range here, we're going to see some farms which are no crop insurance, no insurance plus a $50,000 hedge. So those farms that didn't hedge and had crop insurance will be good. And we can see some farms without crop insurance and and some hedging with some financial stress. So now, that is a backdrop. We're going to go into 2013. And the key date for making my projections as far as, and we're going to stress test these babies. We want to know what the worst we can do. The key date for this all is March 1. And I'm assuming that if the farmers are going to buy crop insurance, if they're buying crop insurance, revenue protection, 75, 80, and 85% coverage levels, when we know those projected prices, we can get a much better feel for what those downside price risk look like once those are set. If we were setting those projected prices today, and those projected prices are based on settlement prices of the Chicago Mercantile Exchange contracts, the December contract for corn, November contract for soybeans, they'd be close to $6.40 for corn, $13.50 for soybeans the last time I checked, and I hope they didn't move the limit today. So if they moved the limit, I could be wrong here. But $6.40 for corn, $13.50 for soybeans, that's above the projected prices for 2012. $6.40 corn, last year was $5.68. That $6.40 for corn would be the highest projected price ever. So farmers would have the ability to set pretty high guarantees. $13.50 compares to $12.55 for last year. $13.50 is close to the high. It's not the high, but it is close to the high. If you're worried about crop insurance policies for next year, they're going to be the same as this year. They're going to be YP, RP, RP with harvest price exclusion. All of those are going to be available. The county level products will be available in a different name. They're comboing that up too, but you'll have the same policies available. Drought year is not going to impact rates for next year. If anything, the forces are that rates will go down next year overall, then up. Having said that, that may, and by rates I mean the underlying structure that determines premiums may go down for 2013 compared to 2012. Again, 2012 yields will not be in there because they're not available yet to base rates on. And even if they were in there, the impacts likely would be smaller than you think they are, because we expect droughts every now and then. It's based on a 25-year period. The subsidy levels are not impacted by Farm Bill. Passing or not passing the Farm Bill doesn't impact crop insurance, except perhaps for enterprise unit levels, subsidy levels. Enterprise units are higher than the rest of them. That was actually instituted in the 2008 Farm Bill, and it would need to be reauthorized in 2012. No one has suggested that it not be reauthorized, and RMA believes, though not certain, that they can continue that without that authorization. So that's what we're going to do here. $6.40 corn, $13.50 for soybeans. Obviously, those prices can change between now and February. Here's some of the changes that have happened between now and February over time. So let me just tell you what this means here. This number here is 10% below. What that means is in that year, the February average was 10% below what it was in December. $6.40 corn, that's 10%. If we had another 10% decline, and 10% was the largest decline we've seen since '72, and obviously we could have larger ones, but historically the largest decline has been 10%. That would take us to $5.75. So we would still have a pretty high price. Soybeans have had larger declines, 18%, which would take our $13.40 down to roughly $11. Soybeans have had larger price declines, but again, overall, history would say that it's highly likely, given where we're at now, that we're going to have over a $6 corn price, projected price, and over a $12.75 projected price for soybeans. So I'm going to use that 640 and 12 or 1350, and we're going to simulate 2013 incomes. Everything's the same as 2012, except we're going to use 610 projected price, 580 cash price, 1310 projected price, 1280 cash price. So I'm a little bit conservative compared to where we're at today. Given that, we come out with a long-run projection of $298,000 for 2013 if we get those projected prices. So, and the math is pretty easy. We're looking at higher prices next year and yields that are higher than they were last year at this time when we were doing projections. So overall, incomes look, if you're giving an average projection, they look like they're going to be pretty good in 2013. Just to give you a feel here, we also put what we believe is more long-run prices here. This is $450 corn, $10.50 soybeans, $91,000. So if we get to what we believe is more trend line, or more prices near what they would be closer to the average, we would believe grain farm incomes for this 1,200-acre farm would be closer to $91,000. So what's the worst that can happen to this 2013 income? And when I'm saying the worst that's going to happen, I'm assuming that they bought crop insurance and they have projected levels at this 580 corn price. That's not good on the equipment, by the way. They shouldn't let professors handle anything that's of value. We got that? Yeah. $91,000. So now we're going to say, what's our worst case scenario? And our worst case scenario comes out to be about $47,000. This is given that they've taken an 80% RP policy and have projected levels at the levels that I showed in the previous slide. That $47,000 would be caused by would be caused by any sort of revenue decline, but the most likely way that would happen would be lower prices. For whatever reason, lower prices happen, we would get that $47,000 roughly. As you've seen this year, low yields aren't necessarily bad for income once you got crop insurance. Because if we're in the, and again, this is a central Illinois, Iowa phenomena. If you have low yields here, prices are going to increase because it's likely that we're going to have supply shortages leading to higher prices. This also assumes we don't have any increase in cost. And you could build a number of scenarios where you would have high cost, I don't know, Asian rust. Finally get here in soybeans and we're spending $90 an acre on fungicides. This assumes that costs don't go up to those levels, or we don't have a large amount of cost impacts as we're going through the growing season. That was for a farm that had 120 acres of owned, 360 acres of share rent, and 720 acres of cash rent. I'm going to look at two other scenarios here. First, we take out that 360 acres of share rent, make it all cash rent, still $300 of cash rent, and then we take that, all that cash rent acres up to $400. Now again, just to show you this, we do have farms that are largely cash rent and have higher cash rents. Here's what that would look like. Our base case was $298,000. We moved to all the cash rent. Actually, our 50-50 share rent was returning the landlord a bit less than a $300, or paying more to the landlord than the $300 cash rent. And a $400 cash rent would result in $205,000 of income. So the 300 to 400, we're just shifting 100 times the number of acres on our projected. Our worst case scenario goes from 48 down to 20, then down to minus $88,000. Again, because under that share rent arrangement, the landlord's bearing some of those risks, and when we get up to $400 an acre cash rent, if prices do go bad, that's what happens. Here's what those would look like under our long run, 91, 68, and minus 49. That would suggest to me that if we ever get back to long run prices, those higher cash rents would have to be adjusted. One other scenario here, I have been using an 80% coverage level. Here's those at lower and higher coverage levels, what happens to the worst income case, and the harvest prices and the soybean prices. Obviously, as we lower those coverage levels, our worst case scenarios do get worse. That's what you would expect with crop insurance. So, to summarize here back though, here's what we're looking at. Here's a long run history. Here's our operator and farmland returns. I showed you earlier 2009, 10, 11, 12, and 13. This is just a bar representation of that. You can see our 2013 projections have corn and soybeans at very wide levels. Again, I don't know what farmers are going to do here. You also see that since 2006, we've generally had higher returns except for the 2009. And that was a year of $350 corn and very high cost. Fertilizer costs were high and drying costs were high. What will be interesting to see is what happens to cash rents. And here, just to this takes some of the previous data, operator and farmland return. Again, that's what's left to split between farmer and landlord. We see that that's going up from 228, 482, 500, over $500 an acre in the last 3 years. And obviously, this depends a lot on the productivity of the land. Lower productivity of land will have higher numbers here, and higher will lower. But if we get back to those long run prices, we're looking at something close to 342, which we've been seeing this go up. This is cash rent data. We'll see what happens when that's no longer if we get back to those long run prices. I would continue to expect to see cash rent prices increase into 2013. Momentum may be less than between 2011 and 2012. 2011 and 2012, you can see that we saw over the state on average over close to $30 increases. In counties in the center part of the state, that was closer to $40 or $50. So average cash rents from 2011 to 2012. Don't expect that in 2013, but still expect to see rising prices or rising cash rents. That's why we're seeing that, along with Treasury note decreases, as a number of the speakers have mentioned, are seeing why we're seeing prices go up for farmland prices. And given our outlook for 2013, we're saying that returns are going to be good. You saw David Abendall, and it's straight from the Fed's mouth. We're going to keep interest rates low. Well, why wouldn't farmland prices keep at their levels or keep going up? So here, just a summary here. Income prospects look decent for 2013. There's farms with typical rental arrangements and average cash rents have little chances of negative farm incomes. And farms with higher cash rent levels, and that would be the farm that I would place in the new high risk category. Large amounts of cash rent at pretty high levels. They've been doing well in the past years, but they're the ones that would face this price decline. And it's sort of interesting. You're sitting here today, you could lock in some pretty good prices. Lock it in, take it. You did that last year, and there's a risk. Last year demonstrates the risk of locking in prices early. And use of crop insurance is a key to minimizing risk for farms. Appreciate your time. Yes, sir.
You used 195 bushel there on that first slide for corn. Cows aren't running, creeks aren't running. How are you going to come up with 195 bushel average on corn?
Yeah, 109, and again, I'm using a 195 bushel corn yield average. Obviously, I'm saying we're having a normal year and we're going to get recharged somewhere between winter and spring. And if you don't get that recharge, you'll be looking at lower yields. So built into that 195, normal yields, a big gully washer of rain sometime between now and May, which doesn't seem like a bad guess, but I don't know. I should not. I'm an economist. I should not stray into another area of predictions where you can be notoriously wrong very quickly. So, but you are right. That's what I'm basing that on.
Any other questions? Joe.
In the years following the drought in 1983 and 1988, what were the trend line yields? Did we achieve trend line yields, or were we below?
In years after the drought, and Daryl Good and Scott Irwin did this analysis, you cannot say you would expect the trend line yields. The chances of getting those trend line yields are just as high after a drought as without the drought.
Anyone else? Thank you, Gary.